Hi, I'm Linda Eedes. This is an update on the RECM Global Felxible Fund, which is our worldwide multi-asset class flexible fund. And that means we can invest anywhere in the world, locally or globally, across any asset class, wherever we find value. And we benchmark this fund against inflation plus 6% per year. And since inception, we started managing this fund in 2003. This fund has actually achieved that objective. It's delivered 11.2% per year since then. But over the last quarter, it did come under a bit of pressure. There was obviously a lot of negative equity markets, both globally, locally, just about across every market that you looked at. But over the course of last year, it actually fared reasonably well. It was down 2.2%, in fact, just slightly less than that, 2.1% after fees for 2018. And that's not such a bad result if you consider the fact that the all-share index was down 8.5% during the course of the year. And over the last 3 years, this fund has actually delivered very good absolute returns. In fact, it's the top performing fund in its category, and it's returned 7.8% per year over the last 3 years. And if you compare that to the all-share index to give you a sense of how equity markets have done locally, the all-shares delivered 4.3% per year. And the average of its category, in other words, all the funds in the category, the average is actually only 0.7% per year for the last 3 years. So that gives you a sense of how most other managers have performed over the last 3 years. And the reason why this fund has done well has been a combination, obviously, of the value opportunities which we invested in, which have come through. And a big part of that has been the resources exposure that the fund's had. And you'll see that the exposure to resources has actually dropped considerably in this fund. We had 3 years ago, probably around 40% of the equity exposure was to resource stocks. Obviously, that's come through very strongly over that period of time. And in fact, today we are actually sitting with less than 20% of the equity still exposed to resource stocks. But last year, some of those resource stocks actually proved to be positive contributors once again. So if you look at the Aussie 40, the top 40 stocks in the all-share index, most of them, more than 30 of them, were actually in negative territory. But the few that actually did buck the trend and produce positive returns included Anglo American, BHP Billiton, and Anglo Gold Ashanti, all of which featured in the Global Felxible Fund. We also managed to avoid some pretty torrid parts of the market. Being a multi-asset class fund, many of the funds in its category will have exposure to property. Sometimes they'll have more exposure or less exposure, but as a rule, they'll have some exposure to property. We have not had any exposure to property for quite some time because we've been quite concerned about that sector for a while. And last year, really, that came to the fore. The listed property sector was down 25% last year. So avoiding that part of the market was very much a positive for our investors. We also managed to do reasonably well on the global side. So the kinds of stocks that we invested in globally actually fared very well. In fact, over the last 3 years, the global portion of the fund has kept up with the MSCI All Countries World Index, or a sort of measure of global equity markets. Now, bearing in mind that we don't hold any technology stocks on the global side, so you'll know probably from the news that stocks like Amazon and Facebook have come down significantly over the last year, and particularly towards the end of last year, but they have been very strong contributors before that. And we actually don't hold those stocks because we believe that you're not stacking the odds in your favor if you buy them at the very high prices, because there's all sorts of good news and very high expectations priced in. And whether those come to pass or not, we don't like sort of assuming that we are able to really make that call about the future prospects of any business. So how we account for sort of not knowing what's going to happen is by buying businesses which are priced very low. So in other words, if things don't turn out well, the price will probably not go down terribly much. But if the market turns out to have been too pessimistic, you've got a lot of upside potential. And on the local side, that really contributed to the returns, particularly in the small to mid-cap space. We actually hold a lot of stocks which are just simply not available to larger managers, and that includes the likes of Stefanuti stocks, That was a very strong contributor last year. It's a construction business, very difficult sector, but that's trading on single-digit price-to-earnings ratios. In other words, the price is very low because everybody knows that it's a difficult time for construction businesses. So if things just turn out to be slightly better than what the market is pricing in, you've got a lot of upside potential, and that has already started to come through, given that the stock really was priced at such low levels. But that opportunity is just simply not available to many other investors. Another stock which contributed very positively, it's actually a preference share, was the Steinhoff preference shares. Now, these are issued by the holding company that owns the South African businesses, which are actually doing reasonably well still. And we actually bought it after the negative news about Steinhoff, and we bought it at 35 cents in the rand. It was paying a 9% coupon. So what that means is that because we bought it at such a discount, at 35 cents, we still get that 9 cent coupon, and so we're effectively getting sort of a 27% yield. That has already paid 2 coupons, since then paid 2 dividends, and we've already got half our money back. So that's been a phenomenal investment, and we feel that because it is issued by the holding company on the local businesses, it's somewhat protected from litigation from the company at the overall level. So that's been a very good investment for our investors. And we seek to really just put together a portfolio of very uncorrelated investment ideas. It's been of huge advantage to us to be able to move away from the large cap space, but we are starting to buy some of those large cap stocks which have come under pressure. So in the last quarter, we introduced British American Tobacco, Richemont, the luxury goods company, Woolworths. We've just started introducing a position there. We've got a very small position in Woolworths, and you will know that that stock's been under immense pressure. We actually added to our banking exposure by adding ABSA, which also came under a lot of pressure, and Aspen, which has also been in the headlines quite significantly. So overall, we've got a portfolio which is split pretty evenly between local stocks and high quality offshore stocks. We do have some cash in the offshore portion as well, and that cash is in sterling and yen. Actually, yen was one of the very few currencies that actually posted positive returns relative to the dollar last year. But the sterling has been under a lot of pressure because of Brexit, and we do feel that that has sort of been overdone. When things start to calm down, we think that sterling does offer a compelling opportunity, which is why we hold some of our cash in sterling and the rest in yen. So overall, a portfolio which is a very compelling combination. I think it's a very safe, sensible portfolio given the global backdrop, and it's invested away from the market where I still think there is quite a bit of risk of downside.